A few days ago, I was walking through my local Costco in Los Angeles. Not Beverly Hills, it's just the west side of Los Angeles. So it's not in some ultra luxury shopping district, right? Just a regular Costco in the middle of upper middle class neighborhood. And there, locked behind glass, I saw whiskey bottles priced at $50,000 and $15,000. They were advertised in a big way. Now, I've never seen that in the Costco, okay, especially that Costco. Now, I go there to buy usual things like paper towels, milk, snacks, maybe some fruit, you know. But apparently, somebody is walking into the same Costco and thinking, yeah, today feels like a $50,000 whiskey day. And that moment kind of stayed with me because at the same time, we all know people who are worried about groceries, rent, insurance, and childcare. And some people are buying whiskey that costs more than a car. Uh, and other people are wondering whether rent will go up next year or not, right? That is, in a very simple way, called K-shaped economy. So a K-shaped economy is when different parts of economy move in completely different directions. Like one group is doing well, their assets are rising, their investments are healthy, and their spending habits may not change much. And another group is falling behind. Their wages are not keeping up, their rents keep increasing, and a small emergency can become a serious problem. And that is why it's called K shaped. Imagine the letter K, one arm goes up and one arm goes down. Same economy. Very different experiences depending on which group you fall in. So, economists often use this phrase when a recovery does not help everyone equally. And this is not just in theory. In 2024, Howard Joint Center for Housing Studies reported that 22.7 million renter households spend more than 30% of their income on rents and utilities. Now, that is nearly half of all the renter households, 49% to be precise. Even more concerning is 12.1 million renter households spend more than half of their income on housing. So, on one side, you have luxury goods, luxury homes, and premium travel. On the other side, you have renters who are stretched thin. You have families making trade offs that never show up in a GDP chart, right? And now, on top of all of this, right, AI is adding another layer of uncertainty. For a long time, automation mostly threatened repetitive work, right? But AI is different. AI is coming for parts of white collar work too, like coding, writing, analysis, customer support, legal review, marketing. Now, those are not fringe jobs, right? These are jobs held by college graduates and skilled professionals. People who did everything society told them to do. They went to college, they got skilled, they built careers. And now parts of those careers may be exposed to automation. That makes the K shaped economy even more complicated because the bottom of the K may not only include low income workers. Some people who thought they were safely on their upward side may discover that their job category is suddenly vulnerable. And that is not good for the economy over the long term. A healthy economy needs a strong middle class because the middle class is a broad foundation of the economy. They rent apartments, buy homes, spend money in local businesses, and create demand. When the middle class is strong, the economy has balance. When the middle class weakens, the economy becomes fragile. You can still have luxury spending. You can still have $50,000 whiskey bottles. You can still have expensive homes selling quickly. But that does not mean the whole economy is healthy. It may just mean the top is doing well. And this connects directly to multifamily real estate. Now, let's try to understand how. Now, at first glance, multifamily owners might think that they are on the winning side of this K shaped economy. After all, if homes are unaffordable, more people rent. And if more people rent, apartments benefit. Now, that is partly true. High home prices and elevated mortgage rates have made home ownership harder. So, yes, multifamily can benefit from structural demand for rental housing. But here is the problem: renters are not just numbers in a spreadsheet, they are customers. And if the customer is struggling, the business will eventually fail it. If the renter are spending 40-50% of their income on housing, there is only so much rent growth they can absorb. And at some point, the math breaks. They may move farther away, they may delay payments, they may leave, and then the property owner has a problem. So, this is the irony. A multifamily owner may live in a luxury house, the renter may live in an apartment, but the owner's income still comes from the renter's ability to pay. So, if the renter is financially stressed, the owner is not immune. And that is why K-shaped economy is not good for anyone in long run, not even the people who are on the upper arm of the K. Because wealth does not exist in isolation. A landlord needs tenants, a business owner needs customers, an investor needs functioning economy. And if too many people are stretched thin, the stress eventually travels upward. It may show up as missed rent payments, weaker consumer spending, or slower growth. This is why investors should pay attention to the K shaped economy, and because it's going to affect them. If you invest in multifamily real estate, you need to understand your renter base. Are they growing their income? Are local rents already pushing affordability limits? Are jobs in the market stable? Are you underwriting rent growth that renters can actually afford? Now, these questions matter because spreadsheets are clean, real life is messy. A model may say rents go up 5% every year, but the renter's paycheck may not agree. A broker may say market is strong, but the tenant ledger may say something else. A city may look wealthy from outside, right? So next time you hear someone say economy is strong, ask one more question: strong for whom? Because in K-shaped economy, that question matters more than ever. Thank you very much for listening to me. My name is Vaibhav Puranik, and this is the OMC Real Estate Podcast. Our website is oldmoneycapital.com. I would invite you to go to oldmoneycapital.com and click on request a call button to arrange a call so that we can tell you how we can help you with your investment goals. Our Instagram handle is oldmoneycapital123. Thank you very much for listening.